In 2024, in the current state of the stock market, is a dividend growth investor better off investing into the Schwab US Dividend Equity ETF SCHD or the popular iShares Core Dividend Growth ETF DGRO? Well, I promise you, stay tuned. We have the answer. You are definitely not going to want to miss this. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So just to lay some groundwork, what are both these ETFs? What do they do? How do they work? First off, SCHD, as a lot of you guys know, is a dividend growth style ETF that has had a history of growing long term, paying dividends consistently, and paying more and more dividends over time. But honestly, DGRO has done more or less the same exact thing. I mean, it even has in its name Core Dividend Growth ETF. SCHD's highlights are a straightforward low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement in a diversified portfolio, tracks an index focused on quality and sustainable dividends, and invests in stocks selected for fundamental strength relative to their peers based on financial ratios. Now, why DGRO? It says DGRO offers low-cost exposure to U.S. stocks focused on dividend growth, access to companies with a history of sustained dividend growth that are broadly diversified across industries, used as the core of your portfolio to seek income. So honestly, as far as strategies go, they're more or less very similar, and at this point I would still consider them more or less a tie. But this is where things get a little bit different. SCHD, as you can see right here, has around 100 different holdings within the portfolio. These are the top 10 holdings right here. We have the Home Depot, we have Amgen, we have BlackRock, we have abbvie, Texas Instruments, Cisco, UPS, we have Chevron, Verizon, and Lockheed Martin. Now, personally, in my opinion, there's some really good names in here. There's some single stocks that I even own in my portfolio, but there's also a few names in SCHD's holdings, which I'm not necessarily thrilled about. Now, DGRO, on the other hand, holds over 400 different stocks, and I would honestly say the top 10 holdings between you and I are a lot better. DGRO's top 10 holdings are things like JP Morgan, Apple, Microsoft, ExxonMobil, Johnson & Johnson, Chevron, abbvie, Broadcom, Procter & Gamble, and Home Depot. So although there is a lot of crossover here, we are seeing some similar names. If you were to ask me, to be honest, I would say DGRO probably has a better top 10 holdings, and the fact that DGRO is more diversified with around 400 plus holdings. For a more scaredy cat investor like myself, I love diversification. I never want to have all my eggs in one basket. DGRO honestly probably wins this one. But not so fast as far as expense ratio. Lining up DGRO next to SCHD, SCHD has a 0.06% expense ratio, where DGRO has a 0.08% expense ratio. Now, I get it, 0.02% is not necessarily anything. None of us would even ever notice a difference. But if we were to stack them up next to each other, which we're doing right here, in 2024, it's more expensive to own DGRO, which might be something to consider, especially if you're thinking about investing a significant amount of money in either of them. Another area where SCHD probably takes the cake is the fact that SCHD has a trailing 12-month dividend yield of around 3.59% versus DGRO's trailing 12-month dividend yield of 2.32%. Now, I know dividends are not everything. Total return is very important, and don't worry, we're going to look through total return here in a second. But if we were to stack up the initial dividend, the initial amount of cash flow that investors are going to receive, whether they invest into DGRO or SCHD, SCHD is going to win, giving investors around a 1% more or less more larger dividend yield than DGRO. But starting dividend is only one thing. What about dividend growth? Dividend growth trailing 12 months for SCHD, 8.86%. DGRO trailing 12 months, 10.84%. So as far as the last trailing 12 months go, DGRO actually has a larger dividend growth rate. But zooming out a little bit over the last 5 years, which is the most amount of data we have to go off of as far as DGRO goes, 9.3% versus SCHD's 5-year dividend growth rate of 12.88%. So honestly, it's probably a tie right there. SCHD long-term has paid more and more in dividends over time, but DGRO as of recently has made a larger dividend increase, which gives it a larger trailing 12-month dividend yield. Now, so far we went through overall strategy. We went through the fact that one of the ETFs probably has a little bit better of a holding breakdown. And we talked about the fact that although one of the ETFs has a larger starting dividend yield, the other ETF has paid a little bit more in dividends over the last year as far as dividend growth goes. Now, as far as price return goes, on the 1-year time frame, SCHD is up around 9%, where DGRO is up around 15.27%. Now, this is going to be largely due to the fact that the top 10 holdings in DGRO are a lot more tech-based. We have things like Apple, Microsoft, JP Morgan as the top 3 holdings as of right now, which again, side note, I'm a huge fan of all 3 of these. I own all 3 of these on their own. Then let's be real here, these 3 top holdings versus SCHD's top holdings, Amgen, the Home Depot, and Texas Instrument. If we were to be completely honest here, I think these 3 have a much better potential to grow a lot faster, which is obviously why DGRO is up a lot more over the last 1-year time frame. But without wasting another second of time trying to figure out which of these investments has done better over the long term, using price return plus dividends included, if of course an investor was to invest $10,000 and reinvest the dividends along the way in both SCHD and DGRO, and this is since around June of 2014 until today, so around 10 years of investing. If an investor did this with SCHD, they would have had a total return on average of around 11.05%, where DGRO would have had an average annual total return of 11.48%, making DGRO the better investment vehicle over this time frame at least. Now, of course, it's hard to compare the two because SCHD and DGRO did not start trading on the same date. They've had different cadences of dividend increases, etc. But just going off of these numbers on this specific time frame, although both these investment vehicles would have been great investment vehicles, and I personally would have been happy with either one of these, DGRO does take the cake on this one. So lastly, to answer the question, which of these 2 dividend growth style ETFs are a better investment for a long-term dividend growth investor to buy in 2024? Well, that of course would have to be up to that individual investor and exactly what they're looking for. For me personally, I find value in the fact that SCHD has a bit of a larger starting dividend yield and has had a lot of data as far as dividend increases long term. But on the other hand, DGRO's top holdings, especially some of the more tech-focused holdings, have the potential to have this ETF grow a lot faster, making your net worth and portfolio skyrocket a lot faster, at least in my opinion. Now, on top of that, there's of course a lot of crossover, there's a lot of similar holdings, and of course a similar strategy with both these ETFs as well as other dividend growth focused ETFs across the market, like one of my other favorites, DGRW. And even though there's a lot of crossover, I personally don't find any problem with owning a little bit of both of them, if of course you like what each ETF has to offer, which is what I personally do, and why I specifically have so many different holdings across my portfolio. But in short, if you're looking for a little bit more cash flow from day one, just a small bit more, SCHD might be a better ETF to buy into for a dividend growth investor. But if you want a little bit more of a growth focused ETF with some top names that have the potential to grow a lot faster, in my opinion, then DGRO might be the perfect ETF for you. But now lastly, most importantly, in the talks of SCHD versus DGRO, if you of course could only hold on to one of these dividend growth ETFs for the rest of time, which one would it be and why? Let us know in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.